bought and sold a couple of small companies, but just I got into mergers and acquisitions specifically while I was after a little bit after college. I was able to get picked up by a company that had about 55 entities and 500 and some employees, and we were growing a lot and really fast. We bought and sold and traded companies, and it felt like on a weekly basis. And yes, John Shefflin, this is exactly how I became bald. So anyway, left there and then just became an independent CFO for several companies, and then joined a firm. And now we are financial consultants on a CFO standpoint. So we're fractional CFOs, part-time CFOs, consultant CFOs, whatever you want to call it. But I deal specifically in mergers and acquisitions, small, medium-sized businesses, 500,000 to several hundred million. So yeah, what happens after you sign an LOI? That's where the fun begins. That's when you really, really get to start digging into the diligence, asking the questions, and hopefully before then you've built your team. People like John, an M&A attorney. And then some specifics in the industry, maybe it's a SaaS company, you want to look at some IP, things like that. But you definitely need to have a financial guy to be able to come in who's familiar with mergers and acquisitions, who knows how to be able to dig in. And so as John mentioned, with Melanie, what we're able to do is they send me the tax returns. I asked, it was actually kind of funny when I asked about, hey, can I see the balance sheet? Like, well, they don't have one. Like, help me understand why. No, well, we just have tax returns. Oh, okay. Well, give me those. I'll build it and see. So we're able to get that. I sent them a bunch of questions. I thought I scared them off, them meaning the target or the seller, because they kind of said, "Oh, wait, hold on a sec. We've got to get this. We've got to get this." And so, I was able to tell them, hey, listen, I'm not here to tell you that you did something right or wrong. Everybody does it differently. I totally get lifestyle businesses where you're writing a lot of the expenses at the company level in order to be able to reap those tax returns. So as I'm looking at the tax returns, I'm able to kind of go in, engage, and see. And I'm used to a lot of specific ways that people have run companies. I've run mine like that too, as a lifestyle. So I'm able to kind of ask questions and be able to flesh out things that really help me to understand what's business and what's personal. Why did this change? What happened here? And that really helps us to understand, A, how did they run the business? And then B, how are we going to run it post-acquisition? And so after signing the LOI, you really, really just want to ask a lot of questions and dig deep and try to figure it out. But understand that depending upon who your seller is, they may get deal fatigue real fast, or they may be okay with that. And so you have to kind of gauge how they're feeling about this stuff. It's a dating game. It's a relationship. Of course, the questions that I ask are predominantly financial based. Hey, how did you do on your marketing? Tell me about some advertising things that you've done that worked and what didn't work, so that we can understand. Really, we were able to flesh out a lot of stuff about that, right, John? That to me was extremely helpful alone.
Yeah. I just want to make a note of that, because when they, just like an example, he's talking about generally you do to everybody, but when Melanie sellers got online, they were definitely, I don't know, 70, 75, and they had these same processes over years and years and years, and it's all in the head. It's not on any, documentation or how to do this if I had to turn it over to somebody. All in the head.
Yeah, so it's, there again, a lot of questions and understanding. And then I'm seeing a question here. Do I have a list of questions or checklists of what to do? Yes, I do. I kind of have some general ones that I can send in for you guys, but a lot of it's very specific to what I'm seeing as well. One of the things, so John, have you guys talked about like quality of earnings and how, some deals may need that and some deals may not?
No, just because quality of earnings is just more expensive on bigger deals. Most of these are SMB deals, so
yeah, so it's higher. And the reason why I brought that up is exactly that. A lot of quality of earnings are more for more expensive deals, but it's kind of the same feel of types of questions. You really want to dig into let me caveat it this way. you guys have heard of audits, okay? CPA firms that do audits. An audit will tell you the what a company's doing and compliance with GAAP. But a financial due diligence, whether it be a deep dive like I do or quality of earnings, which I also do, tells you the how they're doing it and the why. How are they putting this stuff in their tax returns and why are they doing it that way? Why are they spending only a few grand a year in advertising, for a $1.5 million company and they're continuing to grow? How? And that's really the kind of stuff that you dive into, after the LOI. One of the things that I did this morning too, I asked for bank statements. I want to make sure that the bank statement supports the revenue that the company is putting on their returns. And so there's really a lot of diligence like that you really want to find. Now, these questions really tell you two things. Number one, are the reported financials accurate? And that can even kind of branch off, yes or no. Yes, they're accurate, but even if they're not accurate, depending upon the things you're finding, is it maliciously inaccurate or is it just ignorantly inaccurate? Maybe they didn't know. Maybe their accountant or their CPA was doing their financials, but they didn't know that something was on the balance sheet when it really should have been on the income statement. So there's really kind of that difference that you want to find out is, are they maliciously trying to do things? And if so, then that's a red flag. But if it's ignorance, it's not a red flag. It's just, hey, I just got to help them to understand the adjustments and what that means. So first thing is, are the financials accurate? Okay. At least accurate to a point to where you can understand and feel good about them. The second thing it helps you to do is, how do you want to run the company on a go-forward basis? For example, this tire company we just looked at. We can see what they did. We don't know how or why they did that. But if we were looking at buying it, please don't. But if we were looking at buying it, then we can kind of ask them things about, hey, help me to understand, why are your costs of goods so high? Walk me through, your labor force. Walk me through your billings. Walk me through, help me to understand so that I can know what kind of changes I want to make afterwards. And that's really crucial because when you're buying a company, you want to buy the cash flow, the future cash flow. Well, how do you know how much cash you can really pump out of that unless you know what knobs to turn and what levers to pull? So that really kind of is kind of a generalistic idea. John, I don't know if I'm hitting some of the stuff you want to chat about or what.
Can you tell a malicious from ignorant quickly, or do you have to dig deeper?
I'm going to answer with yes.
Yeah.
I have seen malicious, and sometimes it is very quick, and sometimes it's not. I would say probably 95% or more of the things that I'm seeing are ignorance. It's very, very rare that I see a malicious mistake. Now, I have seen a few, and those we have been able to flesh out fairly quickly because I've done over $2 billion of deals, and financial due diligence. And so I've been able to see a lot of things and kind of know, okay, I'll give you a great, easy example. Okay. Revenues are reported at $1 million. But then when you look at bank statements and factor out, non-revenue deposits, and it's only telling you 600,000, and you're asking questions about it and they don't know the answers to that, that's probably a malicious thing.
How often do you see those malicious out of 10 deals that you see? One?
Out of 10, probably 0.5.
Okay.
Not even that. I mean, it's seriously very, very minimal malicious one. Most of the time, it's just ignorance. Keep in mind when you're looking at buying, a small company, 500,000 or $1 million or a couple of $1 million in revenue, it's probably one or two people who have started a small company 5, 10, 20 years ago, and they've just grown it, and their CPA has helped them to do their taxes in certain ways, and they haven't been told anything differently. And it's okay. That's why you have people like me dig in and help you to understand what the real earnings are, and then how are you going to run that after? Yeah, keep the questions coming. I like that.
Let me ask you. You can verify the revenue pretty easy, but the hiding the expenses, pulling them out, or moving them somewhere else. How do you track that? If it's, they put it on a different credit card, then they'll tell you about the credit card.
Yeah, that's the hard part. So that's where it is important to get a balance sheet and really start vetting out, not just a cash to revenue proof, but even look at an expense report, and vetting that out, which is more difficult. And Melanie's example where they don't have a balance sheet, it's really just learning, who the people are and how much do you trust them. And I do have the bank statements, but I don't have a balance sheet or actual income statements, but just tax returns. So when you do have those financials, then it's really looking and trying to figure out, okay, on the balance sheet, I see this credit card and I see it fluctuating in certain amounts, but I don't see the expenses on the income statement changing. That's representative of that. Something fishy is going on here. Or you see accruals on the balance sheet. Maybe it's prepaid expenses, things like that, but you don't see that fluctuate. Or you see, I've seen this quite a bit, where I see a prepaid expense grow and never come down. It's like, oh, that's not getting pushed over to the income statement. Then that means their revenue, or sorry, not the revenue, but their earnings are overstated because they're accruing some prepaid expenses, but they're not booking them on the actual expense. And so things like that you can really flex out. Off balance sheet items, John, great question. When we do, I know we're not looking at quality of earnings here, but when we do quality of earnings, there is a specific question that we ask in every single call. Are there any past, current, or pending litigations? And most of the time, the answer is no. And so in our reports, we will put management represents. Then that way, we as a firm state we've asked that, they've answered it, and so the burden is on them for responding to our answer. And so you can even ask that. You don't have to have a financial person. So you can ask them, hey, I'm acquiring you. Do you have any past, current, or pending litigations? And if they say no, then I would make sure that the attorney that you're working with is putting that, in the documents and everything. And I'm not an attorney, nor do I play one. And so kind of, talk with them through that, but make sure that you're vetting out and saying, okay, well, you've represented to me that there is nothing, that you don't have any litigations. Now you can take that question and ask, are there any financial items that are not represented here? In other words, let's think in, Ron. Do you have an off-balance sheet item? Do you have a credit card that you're using for your company, or even a personal card that you're using for company expenses, but you don't have put in the company? And so there's questions like that you can ask and really and a lot of times, they're not maliciously doing it, but sometimes it's like, oh yeah, I have this credit card that I only use about 4 or 5 times a year, and I put big purchases on it. It's my personal credit card. And oh man, I haven't put that on the financials for the company. And so you need to be able to flesh out stuff like that.
Yeah, and if you they say they don't, they say no, we don't, but you don't believe them, you would add that to escrow or reps and warranty insurance
Yes. Absolutely. Those are standard.
Yeah. All right.
Good. John, do you think it would be helpful if I, and of course this is a redacted deal that's not anybody in this group, so no one will recognize it. You think it'd be helpful to kind of show them, what some of the financial model adjustments and stuff would look like?
If you can kind of show us, what's the first thing that you look at, like the top 3 things, that you would say, that would be like really good.
I will. This will be fun. I think you guys are going to like this. And then John, make sure you keep me on track with time and stuff too. So, and I have redacted this one, of course. So it's, it's an older kind of, I don't want to say older deal, but it's a recent one, but it's one that is fun. Here we go. So this one, I've called it Project Spartan. And let me know when you guys can see my screen.
Yep, I can.
Yeah.
Yep.
See this? Okay. So what happens now, typically, like I said, we'll get an income statement and balance sheet, and majority of people use QuickBooks. Pretty standard. We've used all kinds of other financials, but this one was out of QuickBooks. So to your point, the very first thing I do, I get the income statement and balance sheet by month, and I try to get it for at least 3 years. Okay. So this one, what I've done is I look at balance sheet and income statement. And then what I do as a financial guy is I will just map it. I'm going to show you guys in a second. But the first thing I'll do is start mapping it to some very generic stuff. I mean, when you look at this, you see all kinds of lines down here. There's 93, rows. And so a lot of different stuff. Now, I can go through and look at this, very detailed. But I start seeing stuff like, okay, there's salaries and wages here, there's wages here. I mean, and this is very typical, halfway through, period, I want to start putting stuff in this bucket instead of that bucket. And that's why I will put them together, which I'll show you here in a minute. Same thing on the balance sheet. There's all kinds of different loans and stuff, and so there's a lot of noise that I see. And it's really cumbersome for me to just comb through a lot of noise. So that's why I mapped these to some very generic, very general lines, and that will pull them into this financial model. So I can see, all right, here's a couple of lines of sales. Here's some cost of sales. Here's some general expenses. And then I will be able to start looking. Let me scroll left here. So that's when I can start looking and saying, okay, well, this is interesting. Here's a negative amount of sales. What happened here? And I'll start highlighting stuff, and that's how I build out my questions. Hey, help me to understand in March of 2019, why is there a big reduction of sales? Maybe there's a reimbursement that they did. So I'll kind of, dig into details about that. And for all of you who like Excel, I'm going to show you a trick that I do too. Let's say you want to look at this period. Come over here, click Insert, and just click this button right here. And that just kind of helps you look at fluctuations, So that's kind of stuff I'll look at. All right, well, maybe I'll add a trend line or something and say, all right, well, it looks like they're increasing, but why are these dips here? This looks like it's evened out. So that kind of helps me to start looking at, trends and things as well. So what I do is I look at there again, I will kind of put stuff together as an income statement right here by month. And then I'll do the same thing for the balance sheet. And I'll look at the assets, I'll look at the liabilities, and I'll look at the equity as well, but mostly assets and liabilities. And then with those, and of course, I'm a financial guy. I don't expect you guys to do this, but this is what I do for you, is I'll start building out a statement of cash flows. And then I'll look at net working capital. That way we can know, okay, well, we need to have, X amount of cash in this company in order to continue operating it afterwards. And then over here on the right, I'll look at
How do you calculate that? Just out of curiosity yourself.
net working capital.
Yeah.
Yeah, definitely. So working capital, let's just do a quick review. Current assets minus current liabilities.
Mm-hmm.
Net working capital is cash-free, debt-free. Okay, so I'll go ahead and pull out cash, and I'll make sure that there's no debt. When we say debt, we mean interest accruing debt. And so adjusted net working capital is the current assets minus current liabilities without the cash and debt. And then the way that I calculate the PEG is I'll start looking at, okay, well, what's a 12-month average, a 6-month average, and a 3-month average, and just kind of look and see if it's a growing company where that net working capital continues to increase. We're going to look at the more recent stuff. This is a great example. Right here, we see the 6 and 3-month target are both around 55,000. That's because it's been growing a little bit. Then that's the target that I'm going to recommend. Does that help, Mag?
Yeah, so basically you going up after the highest one here.
I try my best as the buy side diligence guy to recommend the highest.
Yeah.
If I'm advising the sell side, I try my best to recommend the lowest. Buyer and seller are inherently at odds. Okay.
Yeah.
And that's why you need a third party to really give you a third party unbiased view. Of course, there's unbiased, but we always have underlying biases. That's a whole other conversation for another day.
Yeah.
Yes, I will try to
average-
advise on the best one.
Yeah. You don't average the 12 months. Usually some people do that.
Yeah, that's 12-month average right here. And
Oh, okay.
that's one of the pegs. I'll look at the peg three different ways and then just make a recommendation based on what I'm seeing with the business.
Yeah.
Yeah.
Beautiful.
Thank you. Oh, over here, so this is the monthly. And as you see, sometimes we'll work on projects and we'll help you kind of pro forma it out or look at, some forecasts. And then coming out over here.
Hey, Patrick, before you move on, I have to
Yeah.
ask, what do you, and I ask every CFO, CPA this, because small businesses, they always want to take the working capital out. How do you respond to that? Like, well, no, that's the blood of the body. If you take it out, you kill it. Or
How many of you people would buy a car and then make sure that the wheels are on or make sure that the wheels are off? If the wheels are on, that's the net working capital. Would you ever sell a car and say, oh, it didn't include the wheels? That's the working capital. That's how the company has built it. And so I will always make sure that a working capital is at least discussed at length with it. Because if it's not, and I have seen transactions to where, let's say, for example, it was an inventory company. Net working capital was not discussed. I was not involved in this deal until after. Net working capital was not discussed. And during the 4 months of transaction of due diligence and back and forth and everything, the sellers forgot to buy the inventory. Now, whether that was malicious or not, I don't know. Wasn't involved with this deal. But the company was delivered with like 5 days worth of inventory when they usually need like 45 days worth of inventory. And so because working capital was not negotiated, guess what happened to the buyer? There was no escrow either. And so the buyer on day one had to spend a couple of $100,000 to buy inventory. And then they had to spend a lot of time making sure that that inventory was ready to sell in order to continue the business. Now that's a horror story. Doesn't happen all the time, but it's why I'm actually going to be on a podcast or interviewing for a podcast or whatever it's called Tuesday, specific to networking capital and why is it important and how do you figure it out?
Can you provide who once it's published, Patrick, so we can listen to that?
Where, who, and how?
John, is that all right with you?
yeah,
I'll send it your
big
way.
world, man, plenty of space.
Let's just send that out. Yeah, it's a great guy that I've known for a bit.
Who is it?
Actually, Ryan Condi, Let's Buy a Business.
Yeah, I know Ryan.
Yeah, he's a good dude, very good dude. John was on his podcast a few months back and he reached back out and he's like, hey, let's do networking capital. I'm like, I'm on it. So good. Yeah, I was just going to show on the right side over here. So we have monthlies, but then over here is just where I look at, there's the annual, then that's the pro forma adjustment.
By the way, I want to mention how you, aside from growing your podcast with organic growth, just that's the way you get really good growth is get on everybody else's podcast.
That's how I've done it. I don't own a podcast. I think he's the 6th or 7th or 8th that I'll have been on.
Yeah, but that was Michael Oliver and I have been talking about that.
Nice. So over here, here's a couple of other things that I look at. So I showed you guys, how we look at monthlies. Let's just shrink down the pro forma. So we'll look at forecast, but then I look at total annual right here, income statement and balance sheet. I want to see how that changes. How's the cash changed? How's the liabilities changed? That helps. That gives me a lot of insights. For example, on this one, I totally remember this. This was a big discussion that I had with them. I'm like, hold on a second. You have a negative liability. Walk me through that. And that was a big, long, hard discussion that we had with them. And what happened was on this particular deal, their CPA was booking the tax expense to the wrong spot. And so it created a negative liability. So I had an adjustment for that.
Can you explain, go back up to the show that and tell them when you see a number in parentheses, that means.
Oh, right here? Yeah.
Yes.
Negative.
Make sure everybody understands this. When you
That's
see
a negative.
Yeah.
number.
It means that somebody owes you money in the debt section. That's good.
Yeah. So a negative, let me shut my door real quick. My wife's in a meeting. So yeah, when you see a negative liability, it means in numbers, it means someone owes you instead of you owe someone. Now, I know for a fact on payroll liabilities, that's the taxes typically, that the government isn't going to say, oh, well, we owe you taxes for 2 years in a row. They're going to catch that way faster. And that's why I raised that flag for me. This is why you look into the income statement and the balance sheet as much as possible. Okay. Another thing I'll do is not just look at the numbers, but I'm going to look at percentages. This is called common size financials. So on the income statement, as you'll see, the total sales is always 100%. So you're going to common size everything. I'm going to look at it common to the revenues for this particular year. This is another way I can see how things change. For example, look at these salaries and wages. You guys see how this fluctuated? Let's look at this just with that. Okay, so we see it jumped up in the second year and it dropped down and then it continued to increase. So that's how we were able to go back and say, okay, how are you paying yourself and other people, seller? And then we're able to have those discussions. And the way that we arrived at is, okay, what we're going to do is continue to pay you a certain amount, but based on a normalized wage about how we're going to pay you post-trans. This is a seller that was going to stay on board for I think it was 2 years after. And so we were able to make some adjustments that way. And that was, so there's just a lot of different ways that you can look at financials and say, okay, what really is happening? And then how can I take that information and then change or adjust or run this company my way post-transaction? That's why I say after signing the LOI, that's when the fun begins, because that's when you really get into the details of how did they run this? How am I going to run this?
What's the difference between this that you're doing and quality of earnings?
So this is actually kind of a pre-entrance to a quality of earnings. This is the same template that I will use on a quality of earnings, except the quality of earnings, I won't forecast revenue out. I'm only looking at historical stuff. And then I'm going in and saying, okay, what adjustments need to be made? And then I will spend more time validating those adjustments. For example, I will do a cash to revenue proof on a quality of earnings. I will look at a sample of revenues and make sure that that they're in compliance with GAAP. I will look at, okay, well, let's see, the contract of the rent and make sure that's been adjusted for ASC 846. I'm not a CPA, but I know a lot of the tax stuff that we have to look at. So I will make sure that things are right in line. And if they're not, then I will make those adjustments. And then I will produce, it's basically a 30 to 60 page report that walks through everything. And a lot of banks and investors will require that. Smaller deals, they don't. A lot of SMB deals, they do not. But some of the larger deals, I say large, I mean like typically about 1.5 to 2 million in revenue or above is where you really are going to start wanting a QOV.
Gotcha.
Oh, by the way, can you scroll up a little bit where the gross margin was?
So the QOV
That
is
gross
just
margin.
you validating everything, basically. Okay.
By the way,
Validating and providing a lot more context about it. It's a lot
Okay.
deeper of a dive. Very
Gotcha.
deep.
by the way, when Patrick does this and put these numbers in, he looks at these and say, "Oh, there's some anomalies here I want to ask questions about." But he sends those questions to the owners before we get on the phone because they're not going to remember that. And I just want to bring this point because we got on the phone with the sellers of Lenny's deal, and because he had those questions, he had answers ready, or that would have taken like a 3-hour phone call.
Yeah, it's something that is I've learned, just in my career is send them an agenda at least. If when you set up a phone call between both parties, buyers and sellers, you're going to want to do an agenda for a few reasons. Number one, everyone's going to want to know, oh my gosh, what kind of stuff are they going to ask me? I'm nervous, And number two, the more that you can really help them to understand what you're looking for, the better playing field everybody's going to be in. So what I will do is, as I'm looking through this, I will develop that list of questions and I'll number it and I'll send it to them in a Word document. And I will ask them, hey, can you please reply to these on the Word document, send it back. Now, a lot of times they won't. A lot of times they'll say, hey, you know what? Thanks for the heads up. We will actually just discuss these on the call, and that's fine. But at least they know and have a heads up. I would rather them come back and say, oh, yeah, I saw that question. Here's how we resolved it. They'd be like, oh, I don't know. Give me a day or two and I'll go back and look and then respond to you. So I'm trying to preempt things as much as possible with them to create that level playing field for everybody.
That
John,
is
you had a
good. Now,
question about the-
how many questions do you usually ask, Patrick, in regards? Is it like 10 or you bombard them with questions?
It depends. It depends. And you've really nailed it on the head. If there's someone that I feel like is going to get deal fatigue very fast, I will send them less questions and more just high level stuff.
Gotcha.
If it's someone that I know is, so for example, many deals I work on, 20, 50, $75 million revenue deals. And I know that they've been through a lot of growth and everything. I'll send them a list of 2 pages of just heavy, deep questions. I know that they'll be fine. But if it's a mom and pop, where, and this is one where Lenny, I could have been a little bit better and preempted that one and said, hey, you know what? I know you're not going to know the answers to all of these, but nevertheless, here's the questions. I did recover myself pretty quick. I sent them a pretty decent list. It wasn't very heavy, but it was enough where I think they had to take a breath.
More than 10?
It was more than 10. Let's see. I think it's about 25 or so, maybe.
Oh, okay.
But a lot of them are, questions just about, hey, walk me through this change. What happened here? Hey, I see that this happened. Help me to understand. It's just kind of more of a, hey, help me to understand.
You try to understand.
Yeah, exactly.
All right, let's open up for questions for
Patrick. What's the difference in price on the Q&A on the regular stuff that you do?
I will tell you our pricing, and then I'm going to give you kind of some generic pricing that you'll see out there in the industry. So at Amplio, and keep in mind, we've been around for about 30 years. And so I feel like we've nailed this down pretty well. Quality of earnings. Those are typically and like I said, deals, we'll say 2 million and above.
Yeah.
As far as the deal size. Quality of earnings, we charge $15,000 up to $45,000. Our average price is about 20 to 25. For just regular financial due diligence, we have kind of packages, I guess, if you will, where we'll say, all right, pre-LOI, block of 20 hours, $4,000. Then that way, what we'll do is kind of like that workbook I just showed you, where we will dig in. We'll kind of do some light diligence. We'll help you ask a lot of questions, answer a lot of questions, understand what's going on. and I give you some recommendations. Those 20 hours can be used, whether it's one company or maybe you've got maybe 5 hours in. It's like, oh crap, I am not going to go forward on this deal. Then that's fine. You got 15 hours. You can utilize us on some other deals to work on. Where quality of earnings, if you buy it for one company, you can't use that for another company. If it's a dead deal, we'll prorate it, but we're not going to go and say, oh well, that deal didn't work, so now we're going to utilize this information on another one.
Gotcha. And obviously, you're gonna be jumping in a call with us and the seller.
Absolutely.
Okay.
I will jump on, facilitate, involve you as much or as little as you want. And most of the time, first-time buyers want to be involved in everything, which I love that. I love guiding, coaching, and providing information and teaching you because ideally, you're going to buy a company and then a few years from now, you're going to, maybe buy another one. And I'd love to teach you how to do that. And then
Amazing.
Be able to learn and grow.
I have a question in regards to industries. So is your firm industry agnostic? And if it is your price depends on the industry or not?
So Alex, we are absolutely industry and location agnostic. That's the beauty of having 160 consultants, with incredible experience, throughout decades of years. And pricing is actually not so much industry specific, but more target specific. For example, we've done due diligence, whether it's a quality of earnings or just regular financial light touch diligence on very heavy industry like manufacturing, for example, but a very small deal, and we'll charge a little for that. Or if it's a very easy industry, let's say service-based, but it's a large deal and it's hairy for whatever reason, maybe there's multiple companies involved, that makes it more complex, then that increases the price. So the price is based upon, more than anything, size and complexity. Size of the deal, because the larger deals typically mean, more stuff that we have to dig into, or complexity. We've done diligence on very small companies that are very complex, and therefore we charge more.
Okay, understandable. And the last one would be, let's say the deal falls through, and we already spent some hours on that one. I understand the credits if you don't spend that much. But usually, if you see that a deal is not going to work, you would let the buyer know so we can save those hours towards the next deal, something like that?
Absolutely. That's why we like to have check-ins and I've been on many, whether it's a weekly or 2 times a week call, or it's hey, if nothing else, I'm calling you, texting you, and emailing you as soon as I find something that's like, I am not sure what this is, and this may be a deal killer. I'm at least going to give you a heads up on, oh my gosh, let's dig into this more. Let's dig in together, but I'm going to raise the flag right now. So yes, definitely. And we have no problem, being that person. There's been many times where I have been asked by the buyer to even communicate that to the seller, and I don't want to say be the bad guy, but tell the seller, hey, you know what? I'm seeing this and it's a red flag, and we're having some heart pains over this, and it's going to be difficult to overcome.
Okay, great. Thank you.
Definitely. I like that question, Alex, and can appreciate it. Thanks.
Patrick,
see those kind of red flags where you need to call off the deal? I mean, like how complex it is where you're moving along. It's financeable, looks like a good deal, enduringly profitable. We can raise money on it, and you're starting to see stuff. Like, what does that look like?
So, sorry, John, I got distracted for a sec. Ask me that again.
Yeah, so let's see you find a good deal. It looks profitable, enduringly profitable. It's financeable. We get an LOI on it. When do you start seeing this? Like, and the financials look pretty good. What are you starting to see, and how long does that kind of take? Setting some expectations about. Well, we need to call this off. We
typically know whether it needs to be called off or not within the first 5 or 10 hours of looking. So, and I'm gonna address it from both sides, from a financial due diligence, just kind of a workbook side, and then from a quality of earnings side. So from a workbook side, we typically know within those first 5 or 10 hours, hey, something really fishy is going on here. And usually in the first 5 hours, there's been multiple deals in the first few hours that I've dug. I'm like, something's not meshing here. On a quality of earnings is typically within the first week or two, because the first thing we'll do in a QV is a cash to revenue proof. And if that revenue isn't supported by cash in the bank or those deposits, there's some issues there.
Yeah. And you get back to us and say, this is a red flag. You're not telling us to call it off. You're just saying,
I am raising the flag that second. I mean, it's because if I don't do it that second, then I'm on to something else and I'll forget. I get distracted easily, as you just saw.
Yeah.
So I will tell you immediately.
Underwriting's likely going to find the same thing.
Oh, yeah. If I'm finding it, I guarantee underwriting is going to find it.
I have a question about who does the, if you ask the question like, hey, do you have any outstanding liens or IRS problems or lawsuits or something like that? Who does that? Does the legal do the UCC and you connect with them?
Legal does UCC search, yeah.
Yeah. Are you doing that or somebody else is doing that?
No, someone else will do that. So we're financial. So we have outsourced CFOs, CMOs, and HR professionals. We work with I was actually I know a lot of you probably have heard of, or maybe even worked with SMB Law. We were on a call with them this morning. They're great people, and work with a lot of other, M&A, well-known M&A attorneys, but they're the ones that are actually doing those searches, the UCC searches. But we will ask, are there any past, pending, or current litigation? Just at least be able to ask that, and then we will then turn back and report back about that. But we're not doing the search itself.
Gotcha.
So the question is then, talking about that litigations, let's see, everything is fine, attorney get involved, everything is fine. All of a sudden, on the day of the closing of the business, a new lawsuit appears. So maybe it's not a question to you, but have you been through those transactions when all of a sudden liability appears at the closing or after closing, something like that?
I can't recall any. I'm not saying it hasn't happened, but not that I can think of, Alex. I mean, typically things like that have been able to get fleshed out, during the diligence period. Now, I will share a story about a deal that I am aware of. I was not involved with this, but one of our other consultants was. Actually, one of our partners was involved with this deal post-transaction. It was a large deal, multi-$100 million deal. After the deal was closed, the company was acquired by another company. And I think it was, 6 months into it, there was it wasn't a lawsuit, but it had to do with an employee that was not paid on time. And it was like one of their salespeople. And long story short, it ended up being like a $200,000 issue. And there was no escrow to cover it. And so guess who covered it? The buyers, because there was no escrow. Everything was signed off, by buyers and sellers and attorneys and everything. And so how did that fall through the cracks? I don't know. I wasn't involved in that. I didn't ask the partner. I heard about this a couple of years ago. And so I'm not saying they don't happen, they do, but that's why you really got to figure out and make sure you uncover everything as much as you can. Now, with that said, I've heard a phrase, and I've gone by this myself many times, is you're never going to get to 100%. What do I mean by that? You would love to be 100% knowledgeable, know everything 100%. That's what I'm trying to say. But you're not going to be there, because every time you get close to that, then something else uncovers and you kick back down to 50%. So what I have learned to live by is to get to that 80% and be confident about that 80%. I confidently know that I can live with this 80% of the stuff that I've uncovered. And so therefore, this is a green light for me, and I'm going to pull the trigger and move forward on it.
So that's why probably the seller, big portion of the transaction would be a seller financing. So he needs to have a skin because it's always based on
Yes.
live experiences, right? It's always skeletons in the closet, always.
Yeah, always.
Doesn't
And I
matter
love
how
that.
sweet the deal is. Okay, thank you.
You're exactly right. Whether it's a seller financing or an escrow, just as we mentioned, or something that ties the seller to some of that post-acquisition issues, if you will. Or insurance. There's insurances, that cover things. So there's a lot of options for that.
And when you're talking to, you give this score, hey, look, we're 80% confident what's going on here is legitimate, verifiable. Sorry. And how does this move over to underwriting? Do they just start over or do they reference some of your work?
A lot of times they will reference some of our work. So what will happen many times is we'll do what's called a roll forward. Like if we're doing a quality of earnings or if we've done, some diligence before and they need like another period, then we'll do a roll forward or, kind of an add-on.
Gotcha.
There's been a lot of times too where let's say, so what you're talking about is more of the non-reliance, like where we can issue our diligence and reports, whatever it is, to a bank, and we'll have a non-reliance letter that they can sign to and say, hey, we understand that Amplio has done this diligence, but it's going to help us make a decision, but we're not going to hold Amplio, accountable for what they've done. We've got to make sure that we release our reliability, right?
Hey, Patrick, if you can leave your contact information there, would be good.
What do you got?
Definitely. And John, if you don't mind, I just had this QR thing produced. I'm going to put a link. Is that okay? Or do you want me to just email this to you?
By the way, he's on LinkedIn. Just go to Patrick Mamilla.
Yep.
You'll find him on there at LinkedIn.
There we go.
You getting fancy now with the codes, Patrick?
This is not me. This is one of our admin ladies that does all this stuff for me, and that's why I'm sitting there like trying to scan it and email it to me and everything. So give me 1 sec. I think I've got it now.
Look at that. Hey, as long as he has your social security number and everything else.
I know, right? Right? It's here we go. If anybody wants to scan this right now,
yeah, I'll grab it now.
there's a quick QR code there.
Beautiful.
And as John mentioned, I'm on LinkedIn. You can also go to amplio.contact. I'll put that, or not amplio.contact here. Let me put this link here in the chat.
Yeah.
You can do that. LinkedIn, I'll throw that in there. I mean, I'm easy to find on LinkedIn. The QFE guy, people call me that. So I kind of created that as a moniker a while back too, I do a lot of financial due diligence. And it's not just me. I manage our team. Oh, thank you. You got it, John. So we have, at our firm, we have a team of about 8 to 12 of us that do this all the time. And so I spend about half my time doing it, and then the other half of my time helping people, like you guys, just kind of learning about it.
What's the weirdest deal you ever saw?
Oh my gosh. Let's see. Oh, I'll tell you a crazy deal, and it's kind of weird, but it's super interesting. I can't go into too many details because some of you people actually might know this company. It's an e-commerce company. It's very well known on Amazon. It's very well known in the pet industry. That's all I can say about the company. The weirdest thing about it is two things. Number one, talking about margins and how much they spend. They spend 50% of their revenue on marketing, which is why a lot of people know them. And number two, I have now worked on this deal 3 different times for 3 different companies. I worked on it on a buy side when the lender they were doing a recap. And so recapitalization, loaning them money and buying out some of the founders. And then I worked on it when another company a little bit later came in and did a second recap and bought out other people, including that first one. And then now I'm actually, next month, will be re-engaged the third time. They're getting ready to sell to a private equity firm. It's a fun one. It's a very interesting and very fun one.
So was it FBA or just?
It's not FBA. They have a really very well-known product.
Are they profitable? That's the question.
They not at first. They are now.
Okay.
So
Because
give
if they're
us,
spending 50% in marketing, I'm assuming, all the money is going there.
Well, and you're exactly right. That's what happened the first time I did the QVs. They were not profitable because they were spending so much in marketing. But now that the name is out there and they've ramped so much, they don't have to rely so much on that marketing. They've turned it down. They still spend a lot on marketing, but they've been able to turn that down and continue the ramp.
yeah, that's the kind of the hardest thing about entrepreneurs and understand. Sometimes you have to get it out of orbit. Our Earth is only 65 miles, but you have to use 3/4 of your fuel to get out of space so everybody knows you.
That's a great way to put it.
Like how much you need to spend to get to a point where everybody knows you and you're buying your product.
Yeah.
That's tough.
Nice. John, thanks for having me on. If y'all fill out that form online, how did you first learn about Amplio? Put my name, put John's name on there. That way we like to try to understand how people are finding us.
Cool. Thanks, guys. If you have any questions, yes, I did record this, so I will be sending it out later. And if you have any questions, get on LinkedIn and just send a message.
Find me.
Yeah.
Heck yeah. Awesome. John, it's been a pleasure, man. Always love working with you, man. Thanks.
All right. Thank you. And Lenny, thanks for putting that recommendation in there.
Highly recommend Patrick. I mean, I interviewed about 6, CPAs, as you want to call it, due diligence companies, and Patrick had the best deal. He was the most responsive, and everyone could see his energy on this call, which is really important. And it's been a pleasure. So, yes,
I
go to
have
Patrick.
had so much fun, and we're not done yet. We're still working on it.
We're not done
It's a
yet, no.
blast. It is
Yeah.
a blast. I think we found something very enjoyable.
Yeah, for